It is all about the regulation for China, for banks, for drugs, and certainly for crypto. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on the jobs numbers out on the eve of Labor Day.
I still think the road to a soft landing is a very difficult one, but this was a step down that road.
Chip War author Chris Miller on which chips matter in our race with China.
Holding China back has taken on more prominence in recent years.
And former car czar Steve Rattner of Willett Advisors on what's at stake in the UAW's battle with automakers, including a potential strike of 150,000 workers.
This is certainly the highest likelihood of a strike in a number of years, and probably north of 50%.
Global Wall Street spent this last week of summer focused on regulation, at least for those not getting a few remaining days at the beach. Regulation was certainly high on the agenda for Commerce Secretary Raimondo on her China visit this week, telling authorities there that regulatory uncertainty is driving investment away.
I hear about unfairness, arbitrary decisions, a lack of due process, raids on their businesses that go unexplained, tens of millions of dollars in fines for reasons that aren't clear. And as long as that is happening on the ground, that makes it very risky for U.S. businesses to do business here.
Back in Washington, President Biden proudly unveiled new regulations to start negotiations with drug companies over prices for a list of popular pharmaceuticals.
In January of 2026, the new prices will go into effect. But we're not stopping there. Next year, Medicare will select more drugs for negotiations so more Americans get more savings on life-saving medications they need and deserve.
While across town, the FDIC imposed new demands on regional banks holding long-term debt, even though the banks themselves don't see the need.
I see this as a real debate between the banking industry and the regulators. And the regulators are rightfully on course to ensure a resilient banking system when you look at the history of the last 50 years. But the banking industry is correct and say, look at the last 10 years, and loan losses are half at the prior level.
And a federal appeals court down in Atlanta pushed the SEC a big step closer to approving cryptocurrency ETFs, something companies like Grayscale have been pursuing for a good long time.
We purposely decided to set up shop in the U.S., make use of existing rules and regulations, and it's our intention to continue to do so, right? Enabling investors to access this innovative asset class, but in a way that feels traditional, familiar, and again, within those regulatory constraints that they're often used to.
But all those regulations did not get in the way of the jobs market, at least not this month, as the U.S. added another 187,000 jobs, though revisions to last month took that number down some. And unemployment went up from 3.5 to 3.8%, but simply because more people were coming into the workforce. The markets weren't entirely sure what to make of the numbers, ending the day a bit mixed. But for the week overall, it was all good, with the S&P 500 up 2.5%, ending the week at 4515. That's 215 points above the median number where our Bloomberg elves think we'll end up the year, while the Nasdaq was up 3.25%, and the 10-year yield lost 6 basis points to end up just over 4.17. To help us make sense of all this, we welcome now Peter Borish. He's chairman and CEO of Computer Trading Corporation. Peter, thank you so much for being on Wall Street Week. Welcome.
So, with pleasure.
A lot of bulls about equities right now. You have some doubts about it. Why do you have some doubts, Peter?
Well, when you look at the strength of the markets, and particularly the interest rate market, and as well as what the Fed GDP now came out today with growth over 5%, it's hard to think that the Fed is going to pause right here. And in fact, our thinking is that the Fed may raise, it may hold on. I don't think it's going to raise again the rest of this year, but there's very low probability that the Fed cuts between now and Election Day. And the yield curve itself, which, as we know, has been inverted, is likely to move back towards its normal state. And if you think about that, if you have 4% nominal growth, and the Fed now was over 5%, and then you have 2% real interest rates, you could see that the 10-year, which is at 4.17, as you just showed, could easily go towards where the Fed funds rate is, which is 5.5% to 6% by the middle of next year.
And those higher rates are just about never good for equities, as you know. But there are other issues out there as well. We have a looming possible strike with the UAW, maybe a government shutdown. What are the risks in the fourth quarter for the economy?
Well, if we have a government shutdown, and you know that Congress comes back in next week, and think about all the spending that needs to take place. You had the hurricane in Florida, you had the tragedy in Hawaii. If all of that is shut down, that could really significantly slow the economy, but it's temporary. So the Fed is not likely to do anything or go off course. That could then be very challenging for equity markets, because with government spending going down, aggregate demand will be reduced in proportion, and that will hurt stocks.
So, Peter, what does that tell you as an investor? Where do you run to hide if, in fact, we have some of these risks out there?
Well, one of the great places to hide, of course, is in short-term treasuries, because they're paying a high yield. They're safe. It keeps you out of the whole debate of, are they going to raise? Is the yield curve going to move? And I always say the hardest thing in life is to rebalance a portfolio. And if you've had a great run this year, particularly in some of the tech names, going back and reweighting your portfolio to where your weights should be as an investor is something to do. It's always a challenge to do that, because everybody thinks that it's going to continue to go higher. But with volatility goes up, those stocks that have gone up the most are also likely to be the most volatile.
So with volatility, if it in fact does go up, Peter, does that mean you want to be as short-term as you can across the board, whether it's cash, whether it's short-term bonds, whether it's something else?
I think you want to go shorter term, because that's the nature of volatility and uncertainty. And from that type of perspective, when you look at the breakout of energy, when you look at the strength of the dollar, these things are all telling you that the U.S. economy is far stronger relative to the rest of the world, and that's going to continue to put pressure on rates, particularly on the longer end, and that will likely add to stress in the equity market.
Peter, one last one here. China. China's in the news just about every single day. The economy is not going as well as President Xi would like it. They keep trying to do something to shore it up. How does that affect the United States economy and, for that matter, U.S. investors?
Well, China is kind of exporting deflation. You can see that in the relative value of the yuan versus the dollar. And in markets, all marginal demand matters. If China is not supplying that, in their case being the largest or the second largest economy, depending on how you measure it, that will then put stress on prices, and that in itself is a little deflationary, which is ironic, right? Higher energy prices where demand is inelastic causes some substitution effect. A stronger dollar is also deflationary, and that too could be a stress point for profit margins for companies as we go into fourth quarter earnings in October.
Peter, really great to have you. Please come back for Wall Street Week. That's Peter Borish of Computer Trading. And as we head into this Labor Day weekend in the United States, we turn to Louis Rukeyser to remind us about what this weekend looked like back in 1989, a time like now when the dollar was strong, but when consumer debt was on the way down rather than on the way up.
Indeed, this Labor Day week found all the financial markets laboring a bit themselves. While bonds, encouraged by a husky dollar and the late report on lower consumer debt, finished with a gain, stocks went down for the first time in 10 weeks.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We're joined once again by our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. So, Larry, you have been concerned about inflation for some time now, and you've suggested that maybe we need to see a little looser labor market if we're going to get our arms around it. Given the jobs numbers that came out on Friday, are you feeling a little more sanguine about inflation today?
I think these were good numbers. The economy still looks strong, with reasonably robust employment growth, slightly greater than expected. Hours per week ticked up, which is another favorable indicator. Yes, the unemployment rate went up, but it was driven by the fact that more people want to be working and have been pulled into the labor force. And that all happened with wage growth slightly less than was expected. So I think it's a mistake to make definite judgments based on one number, but this is certainly a favorable set of numbers which should please policymakers both on Constitution Avenue and on Pennsylvania Avenue. I still think the road to a soft landing is a very difficult one, but this was a step down that road.
So let me pick up an analogy you've used on this program before about trying to land the plane. Given these numbers, does at least it look like that we're on the right glide path? Not saying we'll succeed, but we're at least on the right path.
These numbers are consistent with very optimistic scenarios. I don't think they determine that they're in a very optimistic scenario, but there are all sorts of things that could have been alarm bells in today's numbers that didn't ring. And that alarm bell that didn't ring, like Sherlock Holmes' proverbial dog that didn't bark, is a meaningful sign that should be recognized. You know, David, as I look to the wage picture, though, I do see, and I think it's very hard for anybody to evaluate the significance of this, a degree of labor restiveness in our country, potential strike activity that we have not seen in a very long time. The Hollywood writers are getting attention, joined by the actors. There was a quite strong wage settlement that was probably not consistent with 2% inflation at UPS a few weeks ago. And of course, the big thing out there is the talks between the automobile companies and the auto workers. That's traditionally been a major template in the economy. The union is very ambitious in what it is asking for, and there's been a lot of workers left behind, and the companies have done well. So one can understand the union being very ambitious, but how that works through, both in terms of potential disruption to the economy if there's a strike, and in terms of inflation pressures, is going to be something people need to watch over the next month.
Larry, you've been in more than one administration in Washington. Take us inside that right now and how the Biden administration might manage, particularly that UAW situation. The president said he is the most pro-union president in history. How does he take that position and help the workers catch up? Because a lot of people think the workers do need to catch up some without going too far and both stoking inflation and perhaps even taking a bunch of workers out.
I think it's very difficult, and I think it's also important to remember that unlike the railroad strike, and unlike potential strike, and unlike some other issues, the federal government has only limited nexus with this situation. So I suspect they will be watching closely, trying to encourage both sides to come together, but avoiding getting too much responsibility for the outcome. These are very difficult situations for administrations.
Larry, let's turn to the international front, if we could. We were all focused on Jay Powell and Jackson Hole last week, but it was the meeting of the BRICS, so-called BRICS, where they added another 6 countries. So this organization originally wasn't an organization at all. It was sort of something developed by Goldman Sachs for investment purposes. Now it takes on a life of its own. It's a wide range of economies they've added, all the way from Argentina on the one hand to Saudi Arabia on the other. Is this a potential economic threat, or challenge at least, to the United States?
I think right now it's a symptom of our failure. It's a symptom of the sin of bipartisan economic nationalism in our country. We are not able to sustain support for trade agreements. We have great difficulty sustaining support for contribution to international organizations. We have lagged in our boldness in putting forth proposals to address global challenges. And so it's natural that the fora where we're seen as leaders start to recede, and there starts to be a demand for other forums. And so I think if we want to address this, we're going to have to move away from the economic nationalism that was so central to President Trump, that was really the essence of what he said. Don't cooperate with other nations, just compete with other nations. But that, frankly, has been maintained in the last while with our emphasis on various kinds of import restrictions, our emphasis on Buy America policies, our reluctance to introduce trade, our declarations that the kind of collective prosperity-oriented strategies that were pursued from 1990 onwards when the Cold War ended are seen sometimes by the administration as a thing of the past. Whenever anybody says they care about producers, not low prices for consumers, they are adopting a negative sum, all against all vision of international economic policy that is problematic and is going to invite these kinds of challenges to the approach that the United States has taken with great success since the Second World War.
Okay, Larry, thank you so very much for being back with us. It's Larry Summers of Harvard, our special contributor here on Wall Street Week. Coming up, Commerce Secretary Raimondo this week reiterated that U.S. problems with China over chips are limited to national security concerns. But is that right? We asked the author of Chip War, Professor Chris Miller of Tufts.
The U.S. controls on the transfer of AI chips to China are going to have both a military but also a civilian and commercial impact.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Commerce Secretary Raimondo spent part of the week in Beijing trying to build a foundation for future U.S.-China relations, an important part of which will center on semiconductors. To take us through what is at stake and what the realistic options may be, we welcome now Associate Professor of International History at Tufts Fletcher School, Chris Miller. Dr. Miller is the author of Chip War, the fight for the world's most critical technology. So, Professor, thanks so much for joining us. I've learned what I know about chips mainly from your book, so thank you very much for that. Let me start with the most basic question. If we talk about a race between the United States and China right now in high tech, particularly involving these semiconductors, these chips, who's ahead and how far?
Well, today there's an international coalition of the U.S., Japan, the Netherlands, and Taiwan, all of whom produce technologies that are necessary for advanced chip making. The most advanced chips themselves are actually manufactured largely in Taiwan, which is multiple generations ahead, almost a decade ahead of the capabilities that the leading Chinese firms have.
When we talk about chips, one of the things that Secretary Raimondo emphasized, and we've heard it before from the administration, emphasized this week was we want to separate national security concerns from basic commercial concerns in our competition with China. Is that doable when we're talking about these very, very high-end, cutting-edge chips?
Well, there are certain types of chips that are only used in civilian or only used in military applications. But when you're looking at the chips that are used for training AI systems, they're used in both. The exact same type of chip that can train a car to drive autonomously can also be used to train a drone to fly autonomously. There's just no technological way of differentiating. And that's why the U.S. controls on the transfer of AI chips to China are going to have both a military but also a civilian and commercial impact.
So in your book, you talk about the history in the United States and elsewhere of a relationship between the military on the one hand and development of semiconductors on the other. We now are talking about AI all the time, whether it's civilian or military. How much of this competition over semiconductors really is turning into an issue of generative large language artificial intelligence?
You know, every military in the world, every intelligence agency, they're all trying to understand how they can better apply AI and autonomous systems to defense and intelligence uses. Now, most AI is going to end up in the civilian sphere, but we can't underestimate the extent to which, whether it's autonomous drones or better intelligence systems, they're already beginning to rely on AI, which means they already require advanced chips to train them to act more intelligently.
So, Chris, you say that we may be as much as a generation, which is maybe as much as a decade, maybe a little less ahead right now of China. Can we preserve that lead? I mean, those of us who remember sort of the Cold War remember thinking that maybe the Soviet Union could never get an atomic bomb. They came up with it pretty quickly.
Well, there's two aspects to preserving the lead. One is racing faster than the Chinese, which we've historically been pretty good at doing alongside the Taiwanese, the Netherlands, the Japanese. And if you look at all of the R&D money that the West is pouring into its chip industry, it's substantial, and it's kept a really dramatic lead over the past couple of decades. But China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. And that's why the US, Japan, and the Netherlands in particular have tightened up their export controls on chip-making tools, which now can no longer be transferred to China to help China produce cutting-edge chips. And so the second prong of the strategy, holding China back, has taken on more prominence in recent years.
So those chip-building machines, again, I learned from your book, the lithography machines, right, that seem very, very sophisticated, very high-end. And as you say, there are restrictions now placed on the ability for Western countries to export those into China. Can't China reverse engineer and make their own lithography machines?
Well, chip-making tools are really the most complex tools that humans have ever made. If you look at the most advanced lithography systems, which are produced just by one company, ASML in the Netherlands, these have hundreds of thousands of components inside of them, including the flattest mirrors humans have ever made, one of the most powerful lasers ever deployed in a commercial device, and an explosion happening constantly inside of them at a temperature of around 40 times the surface of the sun. So this is really extraordinarily complex engineering. And even if you copied all of the files, you can't simply paste it into your computer and hope to replicate it straightforwardly. And the other facet is these machines are getting better and better on a regular basis. ASML is already preparing in the next year or two to release an even more capable lithography system. So again, copying the last system is not a great strategy for technological catch-up.
So far, we've been talking about export restrictions, other restrictions to keep China from catching up. What about attempts to really build up the capability of the United States and other Western countries? And let's talk specifically about the Chips and Science Act, because that was billed as something that we needed to do so that we had our own homegrown. How realistic is that we can, through the Chips and Science Act and other activities, build up our capacity here to match, for example, what we're seeing with TSMC over in Taiwan?
Well, the U.S. is never going to be independent in semiconductors because the supply chain is just too interrelated with Taiwan, with Japan, with Europe. But the goal of the Chips and Science Act is to put more money behind equalizing the cost of producing chips in the U.S. relative to other places in Asia.
Okay, Chris, thank you so much for being with us. Really appreciate it. That is Professor Chris Miller of the Fletcher School at Tufts. Coming up, as the U.S. heads into Labor Day, the auto industry heads toward a standoff in 2 weeks with the three major automakers. We go over the bidding and the likelihood of a major strike with the man who ran President Obama's successful effort to remake the auto industry, Stephen Rattner of Willett Advisors.
I'm a great believer in unions, but when you start talking about work rules, then you start cutting into productivity.
That's next on Wall Street Week on Bloomberg.
The most pro-union president in American history. That's what Joe Biden proudly calls himself.
I made a commitment that I'd be the most pro-union president in American history. I'm keeping that promise.
And this summer, he's getting the chance to prove it, as a series of labor disputes have hit the country in rapid sequence, starting with the threatened strike of UPS workers avoided when management agreed to a very large pay raise.
First-year analysts eat your heart out. UPS drivers could make $170,000 a year in annual pay and benefits thanks to a new 5-year contract.
Added to the ongoing strike by Hollywood writers, who were followed out the door by the actors, with the prospect of it going well into the fall.
All of our members know that they are fighting for something that is existential for them. This is about the future of being able to be an actor in this industry. It's about making sure AI doesn't take away their jobs.
And now we have what may be the biggest one of all, as the UAW is threatening to strike Ford and perhaps others unless its demands are met, with a deadline looming not long after Labor Day.
We have a potentially massive auto strike on the horizon. You have the head of the United Auto Workers Union is now threatening to strike against GM, Ford, and Stellantis, the big three, unless workers get a 46% raise, a return to traditional pensions, and a 32-hour work week.
What do we want? Justice! What do we want now?
Liz Schuler, the head of the AFL CIO, says there are larger issues at stake for the workers.
It's about workers feeling taken for granted, having sacrificed through a pandemic. Workers feeling disrespected, knowing that they have sacrificed for these companies, and yet in an era of record profits, that these companies can't find just a little bit more to take care of the people who are making them successful.
But employers like UPS warn that accommodating all the union demands can only hurt their performance.
Looking at expense in the U.S. domestic segment, the union wage rate increases, including in our new labor agreement for the first year, are higher than we originally planned.
However it all comes out, the one thing that's for sure is that taking the UAW's 150,000 employees out of the jobs market would pose a major problem for the U.S. economy.
We have our auto sector coming back strong. We have deep investment in this transition to electric vehicles. So we want to continue those trends going.
To take us through where we are on the UAW negotiations, we welcome now someone who knows the U.S. auto industry like few others. Stephen Rattner headed President Obama's task force on the auto industry in 2009, leading to its restructuring, and many would say its salvation. He is chairman and CEO of Willett Advisors, which invests the personal and philanthropic assets of Michael Bloomberg, who, of course, is our founder and majority shareholder. Steve, thanks so much for being back with us. You do know these things so terribly well. Give us your sense from a distance. I understand you're not in the negotiations, but what is separating the two sides, the UAW on the one hand and the big three automakers on the other?
I would say roughly something the size of the Pacific Ocean. This is really a scary situation. We've had many labor negotiations between the auto workers and the UAW over the decades. We've had some strikes, unfortunately, but some of them probably were inevitable or even perhaps necessary. This situation is really scary for a number of reasons. First, you have a very activist new UAW leader who I do not know personally, but who has said very inflammatory things, didn't do the traditional GM or auto worker initial handshake, which is just symbolic. He doesn't have to do that, but more importantly, has put out a set of demands publicly, which is unusual in itself, that are an utter laundry list from everything from a 32-hour week to a 4-hour week to more holidays, to more job restrictions, to a restoration of defined benefit pensions, just a long list of stuff that is just beyond the pale in terms of any auto company's ability to meet it.
Now, one of the things that Sean Fain, I guess is the name of the head of the UAW, has said is they need to make up for some lost time. There has been a lot of inflation, as we know. They were operating under a labor contract that really didn't allow that inflation to be taken into account. Can you separate out what is truly making up for lost time, catching up with where they should be, maybe advancing a bit, as opposed to fundamentally changing the business model for the auto companies?
Well, I think that when you talk about asking for pay increases, and they've asked for very large pay increases as well, that sort of falls into the making up for lost time category. Although I would acknowledge that, or I would note that they did get fairly substantial profit sharing bonuses as a result of the auto companies being more profitable. They have had wage increases and so on. So it's not like they took massive pay cuts in recent years during this inflationary period. But the bigger thing of concern to me is everything around the actual pay level. And it includes things like the number of hours worked, when overtime kicks in, how many holidays you get, how many personal days off you get, things like that. But here's, David, the thing that is the scariest of all to me, which is work rules. I am a great believer in unions. I'm a great believer in the right and the ability of unions to bargain for higher compensation and for certain kinds of other benefits, healthcare, things like that, that we all know are important now for workers to have. But when you start talking about work rules, then you start cutting into productivity. And then we start going down a slippery slope we've been down before with bad effects. When we got involved with the auto sector, and at General Motors in particular, I remember, there were something like 300 job classifications at General Motors. If you were an electrician, you couldn't touch a piece of plumbing. If you were a truck guy, you couldn't do something else, and so on and so forth. And it makes for a highly inefficient production process and works to the detriment ultimately of everybody. And the unions have come back now and asked for the reinstitution of some, happily not all, of the kinds of work rules that we had before 2009. And that kind of rolling back of this sort of wholesale rolling back of the clock is a very dangerous place to be. So, but let me say one other thing. In terms of all of these wage settlements and negotiations you see going on, whether it's UPS, whether it's the auto industry, whether it's whatever, you have to really separate in a way. I know this doesn't sound necessarily completely fair, but you have to separate the so-called tradable sectors from the untradable, non-tradable sectors like services. Paying the UPS workers more absolutely contributes to inflation. It affects every American who ships something by UPS and obviously benefits the UPS workers. Doing something similar in a tradable sector, by which we generally mean goods that can be traded across borders, you do run into international competitive issues. And this was part of what ailed the industry back in 2009. The yin and the yang of this is if you raise wages too much, then production will flow somewhere else, most notably in Mexico, which has had a disproportionate share of production increases in the last 15 years. Or it will flow from the north, from the unionized plants in the north to the non-unionized plants in the south that are operated by a lot of the foreign companies that are coming here. And that does save jobs in America, but they're much less remunerative jobs. And they're located in places in the country that perhaps don't even need the jobs as much. So there's a lot of complexities to what is a fair and appropriate level of wages once you start getting into these tradable sectors.
Steve, as you lay out, there's a dynamic in this negotiation, a lot of concern about whether they can actually bridge the gap. But this all comes against a backdrop of larger changes afoot in the electric vehicles. And that's showing up, as I understand it, already in some of, for example, the battery plants with some joint ventures, where I think the UAW is saying, wait a second, they should all be subject to UAW as well. How big a problem is that as the auto industry looks, both workers and employers look forward to a very different world with electric vehicles?
Yeah, that's definitely a complicating factor. Electric car plants, electric cars in general, require many few man hours of labor to make, as I'm sure you know, fewer moving parts and so forth. And so in the long run, it does raise the question of the level and extent of auto jobs that we're going to need in this country or anywhere else for that matter. It's not all going to be done by robots, don't get me wrong, but is there going to be some cap or some lessening of the number of jobs we need? And then you have these new, and I think you're speaking particularly of Ford, which has these joint venture battery plants. Should they be unionized or not be unionized? And again, I would come back to the same sort of set of trade-offs that if you unionize them, if you impose the same kinds of restrictions, requirements, and so forth on those plants that we do on traditional assembly plants, then a lot of those jobs may not end up coming here. Whatever number of jobs there are in the electric battery area, some of them will not come here because it'll just become too expensive to make the stuff here. So there's got to be compromise on both sides. We have to find a happy medium. But my strong encouragement to the union side of the equation is to focus on pay and benefits. I think those are really important for union workers, for all workers, and not create impediments to management being able to manage those plants as efficiently and as effectively as possible.
Steve, you're a banker and an investor. You're not a labor negotiator that I'm aware of, at least. But from an outside position, how do you see a way forward for essentially for the UAW maybe to climb down off some of those demands, perhaps the auto workers to come up forward? And also, by the way, what role does President Biden administration play in this? Because President Biden has said he's very proud of being very pro-union.
Yeah, as I said earlier, I think this is going to be, I don't know exactly how this is going to end, because I think this is a tough one. These negotiations are traditionally held with a good bit more secrecy than is surrounding this one. And Shawn Fain has put himself way out there, and it is going to be difficult for him to climb down from that with his membership. He's been out touring plants and fighting, cheering on with the fight songs and all the rest of that stuff. And it's going to be complicated. And he's conducted this much more in public than has traditionally been the case. I understand where the president's coming from. He's very strongly pro-union. I'd like to think I'm pro-union too. But I think the president's got to be careful here, because if he, in a way, encourages the unions to create even more demands that are simply impossible for the car companies to meet, then this is going to end very badly. I would say, I think the handicapping around the industry that I hear at the moment is that this is certainly the highest likelihood of a strike in a number of years, and probably north of 50% somewhere that will have a strike out of all this.
And one further point, at least I am asking about that, is how big a strike? I mean, when I was a boy in Flint, Michigan, and my dad worked at AC Sparkplug, there were strikes. But typically, my recollection was the UAW would go after one auto company, get a deal, and then go to the other auto companies. Shawn Fain is talking about doing all three at once. Is that plausible?
It's certainly plausible and also scary. Yes, I have seen all that. And everything you said about the history is correct. Traditionally, they've picked one target and struck that one. But yes, Shawn Fain is talking about striking all three of them.
Thank you so much, Steve. Always so great to have you on Wall Street Week. That's Steve Rattner of Willett Advisors. Coming up, it's not just the auto industry that's going through labor strife this summer. We'll talk with the Dean of the Cornell School of Industrial and Labor Relations, Alexander Colvin, to take us through the apparent shift and why it is happening now.
Technology and changes in how it affects work have been one of the real central drivers of change.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. As we approach Labor Day in the United States, it's not just the car companies contending with labor unrest. We've also dodged the strike bullet with UPS, and we're well into a prolonged walkout by directors and actors in Hollywood. For a broader perspective on labor management relations, we welcome now Alexander Colvin. He's Dean of the Cornell School of the Industrial and Labor Relations. So, Dean, thank you so much for being with us. You do give us a broader perspective. Is it just our imagination, or is there a shift going on right now in the relative balance between labor and management?
I think there really is a shift going on, and it's a function of labor having a bit more power right now. The labor market's tight, and so that always gives labor unions more power. But I also think there's something within the labor movement. There's been more organizing, more activism towards strikes. And so all these things are combining to give labor some more power than it's had for a while.
So you pointed out that the labor market has been tight. We are starting to get a little bit of indication. Maybe there's some loosening. The JOLTS numbers this week were a little bit looser than expected. Sooner or later, the labor market will adjust itself, I assume. And so the question is, what will be left, if anything, of this shift at that point? Or is this just a relatively short cycle?
We always see the ups and downs of the labor market. There is a cyclicality to it over time, and that affects labor's bargaining power. But I do think there could be some lasting effects of this period. Labor is catching up after having fallen behind for a period. So I think they are looking to use the power they have right now to lock in some gains, to really catch up to where they fell behind for quite a while, particularly on issues like wages.
Well, I was going to ask exactly about that. What are the big issues, if there are big issues, that cut across some of these industries? We have seen the UPS situation with UAW. We've got the DGA as well as SAG-AFTRA. Are there common factors across all, or are they pretty much idiosyncratic?
So certainly the wages issue does cut across the basic economic issues. And that's sort of a return to something that we saw a lot farther in the past. There wasn't a lot of wage gains for a while. There was more focus on benefits and bargaining, but wages have really come back. Certainly during the higher inflation period, wages became more front and center. I do think there's a few other things going on across different industries. Technology matters. AI as a threat to the writers and screen actors is an example of that. The electric battery expansion that we're seeing in the auto industry as an example, in that industry of technology changing things. So I think that's a common theme we're seeing as well.
I was going to ask about technology specifically, as you say, AI with respect to the writers, and then we have EVs with respect to the car companies. Have we had other instances in history, as you go back, where both sides, labor and management, knows there's going to be a fundamental shift? It's hard to know what's on the other side. How do you provide for that in a collective bargaining agreement?
Absolutely. We have seen over really the course of labor history that technology and changes in how it affects work have been one of the real central drivers of change. And it can change it in perhaps unexpected ways. One of the most famous things was in the mining industry. The president of the Mine Workers Union back in the 40s and 50s made a kind of conscious decision that technology was going to take away a lot of jobs, but what they were going to do was bargain for higher wages. So there'd be fewer workers, but they'd be paid better. And so labor has choices to make about how they're going to adjust to technological change.
I wonder if labor also has to think about, at least the possibility of, I'll put it this way, killing the golden goose, the goose that laid the golden egg. Because we are not that far past the time in the auto industry where we're looking at bankruptcy for two of the majors. Maybe Ford would have followed at some point. Do the union have to really take into account if they push too hard, too fast, they could drive the auto companies to bankruptcy again?
Well, the auto unions absolutely need to come up with a deal that does help ensure the future of the American auto companies. And we've seen this story before. We go back to the 80s when Honda, Toyota, the Japanese car companies, were really taking it to the American automakers through more fuel-efficient, higher-quality vehicles. And the American companies had to respond to protect what jobs they could and to be a significant part of the industry. I do think there's a real danger again right now with a transition to electrical vehicles. The American unionized automakers need to make sure that they're in a position where they can be on the forefront of this. The UAW wants to be part of it. They want their members to be making those cars, making those batteries, but they have to come up with a deal that lets them both work together on this.
We've seen a long-term trend away from organized labor, specifically in the private sector. Do you think some of the factors, whether it's technology or otherwise, might turn that around to some extent?
I think there's a possibility. I think it's definitely not determined that we'll see a turnaround, but there is a possibility. The thing that jumps out to me is that there's been a shift in attitudes around unions, more favorable views of unions, particularly amongst younger workers. There was a recent poll showing over 80% of them have favorable views of unions. And I think that's being reflected in things like organizing we're seeing at Starbucks. That is a representation of a shift in attitudes of younger workers that could have a long-lasting impact.
And finally, I wonder about the role, if there is one, of the government. We've heard repeatedly from President Biden that he wants to be known as the most pro-union president in American history. And we'll see whether he goes down that way or not. But in taking that position, could that, to some extent, make it more difficult to come to terms because he's really getting the hopes of, for example, the UAW up?
I mean, I think he certainly is getting the hopes up. He's setting down that marker of saying that, I am in favor of unions, and I think that's important. He's certainly the most rhetorically supportive of unions since FDR. As to whether that will backfire in some sense, I'm not sure it will. We certainly saw last year with the railroad threatened strike that Biden seems to take a balanced approach. As well as being pro-union, he does believe in collective bargaining, reaching a deal. I think there's still opportunities for cooperation and reaching deals.
Okay, Dr. Colvin, thank you so much for being with us. Always good to talk to you. That's Dr. Alexander Colvin of the Cornell School of Industrial and Labor Relations. Coming up, looking for some diversion before heading back to work next week? We'll look no further than the unpredictable, sometimes disturbing, and potentially uplifting world of sports. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Sports are as necessary to divert the mind as the body. So wrote English author and bookseller John Dunton in 1707. And this summer, we've had plenty to divert both our minds and our bodies, even if New York fans haven't had much to cheer about when it comes to their baseball teams.
Okay, if you want to field a good team from free agency, that's what it costs. If you want to fill all the positions with hopefully quality players, okay? And sometimes you can get it right, And sometimes, things go wrong.
This week, we had the return of gymnastics legend Simone Biles, winning a record 8th national title 10 years after she won her first at the age of 16.
We're proud of Simone. I mean, look, she's proven beyond a shadow of a doubt that she's maybe the top gymnast ever in the history of the sport.
And another legend, Lionel Messi, debuted for his Inter Miami team and scored a spectacular goal in the 89th minute, even if he wouldn't talk about it with reporters after the match.
Honestly, the Messi moment has sort of bridged that gap, and now soccer is front of mind for the general public here in the United States.
If gymnastics and football, and by the way, are we still calling it soccer in the United States? Well, in any event, if all that isn't enough, others are trying to add some more exotic fare to our list of diversions, like Anurag Jain, working on bringing cricket to the wilds of Texas.
We're putting in great infrastructure, getting the top players in the world to come here and play. And what the fans are seeing is an amazing quality product. That, we're told, is the most important thing to get anything going. Pickleball, rugby, or cricket.
But not everyone has gotten with the program of helping us find our favorite sports diversions, like President Maduro of Venezuela, who picked this summer to go after pickleball because of concern it was getting too popular in his very troubled country and was taking up too much space. Unfortunately, this summer, we've also seen a return of questions about the participation of women at the highest levels of our sports, when the head of Spain's National Football Federation, Luis Rubiales, snatched defeat from the jaws of victory after his country's team won the Women's World Cup. And he decided to celebrate by placing his hands behind the head of a star player, Jennifer Hermoso, and kissing her full on the lips.
The Spanish government has interfered now in the situation, saying that he's no longer in a condition to lead the team, and there's also real pressure on the coach too for other issues that played out in the past. So again, it's a sad situation, almost bizarre too, and also it's a shame that the entire win has now been eclipsed by this incident.
So maybe it's only fitting that we end our sports summer on two high notes. Over 92,000 fans gathered to watch a women's volleyball match, a record for any women's sporting event ever.
I think the biggest thing is women's sports are a big deal here. And they got to experience what the men get to experience on the same level as all the greatest football teams that have played here. We just got to experience it, and maybe in some ways even more.
And this week, the greats of tennis gathered once again at the U.S. Open in Flushing, Queens, celebrating on opening night a true sports milestone, turning to the woman who led the charge, tennis legend Billie Jean King, who told a crowd that included former First Lady Michelle Obama, quote, "We're here to celebrate a moment 50 years ago that changed our sport and all sports forever. Equal prize money at the U.S. Open." Sometimes sports is much more than just a diversion. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.